Welcome to the deep dive, where we take these really complex financial structures and market dynamics and turn them into knowledge you can actually use.
Right.
Today, we are tackling a sector that's scaling at, well, at breakneck speed, medtech. Our mission is to really understand the financial architecture investors are using to deploy capital here. And we're focusing on why Luxembourg has become this indispensable EU hub for it all.
It's a crucial topic because the investment challenge, it matches the scale of the market. This isn't just about finding good companies.
Wow.
It's about finding a structure that's efficient enough to handle cross-border regulation and, at the same time, this massive growth potential.
And that growth is, well, you just can't deny it. The global medtech market, we're talking devices, diagnostics, digital health, AI, is estimated at well over $650 billion in 2024.
That's a huge market, and the capital's falling right behind it.
It is.
We've seen reports, I think health tech startups across Europe and the U.S. raised close to $8 billion just in the first half of 2025. That's a serious rebound.
So if you need international capital to fund, say, a German AI firm or a French robotics platform, you need a structure that just minimizes all that friction.
That's it. That's why we're zooming in on the nuts and bolts of the Luxembourg setup.
Right.
We want to give you a shortcut to understanding the specific fund vehicles, the frameworks that let global investors maximize their reach across the EU while, getting comfortable with the governance and risk that comes with life sciences.
Okay, so let's start by mapping the terrain. Medtech. It used to just mean physical devices, right? Now it seems like a fund has to be way more diversified. Can you break down the key subsectors for us?
Yeah, a smart fund today is really an umbrella strategy. It covers the full patient journey. So first you have the foundation, medical devices and implants.
Okay.
Things like cardiovascular stents, smart prosthetics. That's a high-value hardware.
And I'm guessing that hardware has to rely heavily on diagnostics, right?
Precisely. That's the second piece. In vitro diagnostics and lab automation. This is your molecular diagnostics, point-of-care tests, all essential for remote healthcare.
And then comes the big growth engine everyone talks about.
Exactly. The third is digital health and AI. This is everything from AI reading radiology scans to telemedicine platforms.
This is where we see that double-digit growth we hear so much about. What else fills out the map?
The last two are really infrastructural. Fourth is health data infrastructure. It's the backbone. Secure data lakes, cybersecurity for hospitals.
Crucial stuff.
Absolutely. And fifth is hospital and home care solutions. This is all about shifting care out of the clinic. So connected infusion pumps, home dialysis, that kind of thing.
That's an incredible amount of depth. And the numbers back it up, right? Medical devices alone are forecast to jump from around $570 billion in 2025 to over $880 billion by 2032.
That's a CAGR over 6%. And the digital parts often grow even faster. But what's really fascinating here is how this diversification connects directly to the fund structure.
How so?
It lets managers create multiple separate investment strategies. We call them compartments, all within one single fund in Luxembourg.
So you could have one compartment for, say, early-stage European AI and another for later-stage U.S. surgical devices?
Exactly. And the benefit isn't just organizational, it's a legal one. It's about ring-fencing the risk.
Okay, what does that mean in practical terms? Ring fencing.
It means you're legally separating the assets and liabilities of each compartment. So if that early-stage AI compartment completely fails,
The losses can't touch the other compartments.
the losses cannot legally impact the assets in your successful surgical device compartment. It's crucial for protecting institutional investors.
That clarity on risk is a great foundation. So now let's get to the hub itself. Why Luxembourg over other financial centers? Let's get into those three decisive advantages.
Okay, it really boils down to regulatory certainty, market access, and fiscal efficiency. Advantage one is what I call the fund toolbox.
Toolbox.
Yes. Luxembourg offers this menu of AIFMD-aligned vehicles, the RAIF, the SIF, the SICAV. Managers can pick the one that perfectly fits their needs.
So they can fine-tune the structure before they even raise the first euro.
Exactly. Then, advantage two, and this is the cornerstone for Europe, is the EU single market passporting.
The passport. This is key.
It's everything. Because these funds are managed by an authorized AIFM, they get the AIFMD passport. This gives them full access to market across the entire European economic area.
So a manager in Luxembourg can just seamlessly go talk to professional investors in Stockholm, Paris, Berlin.
From one central point.
That's one structure, access all of Europe, a huge efficiency gain. What's the third advantage?
The third is tax structure instability. The environment is politically stable, and the corporate tax for, say, a general partner in Luxembourg City is competitive, around 23.87% from 2025. But the real magic is at the fund level.
Ah,
A
okay.
diversified RAIF, for example, is typically exempt from corporate and income tax.
Wait, so if the fund isn't taxed on its gains, where does the government make its money? Isn't that risky for long-term stability?
That's a great question. The government makes its money from all the economic activity around the fund, the management fees, the service providers, the legal work, the banking.
I see.
The fund vehicle itself is tax neutral. So instead of income tax, it pays a tiny 0.01% annual subscription tax on its net assets.
So the income flows right through the fund, untouched, to the investors,
Yeah,
the limited partners.
exactly. And they pay taxes in their home country. It preserves the investor returns, and it's all completely compliant within the EU framework.
So for you, the listener, what this all means is the Luxembourg platform is like a unified command center. It lets one structure handle complex US and Asian investors, stick to EU rules, and deploy capital efficiently all across Europe.
That's it.
So let's decode these fund wrappers. We have the toolbox you mentioned, RAIF, SIF, SICAR. For a Medtech VC fund today, which one is the default winner and why?
For venture capital, especially if you want speed, the choice is overwhelmingly the RAIF, the Reserved Alternative Investment Fund.
And the key feature is in the name, you said, reserved.
Right. It is AIFMD compliant, so it gets that EU passport. But here's the trade-off. It is not directly supervised by the CSSF, the financial regulator.
So if the regulator isn't looking over the fund's shoulder directly, what's the backstop?
The backstop is the authorized external AIFM. You have to hire a regulated manager, and that manager takes on the responsibility for risk, compliance, reporting, everything.
I see. So the SUF is like it needs constant government sign-off.
Yes. The RAIF, though, is a fast track. It relies on the AIFM's regulatory stamp of approval to get to market quickly. It can save months.
Speed for the manager, but regulatory comfort for the investor.
That's the idea. And within the RAIF framework, VCs almost always choose the SCSp, the Special Limited Partnership. This is the key to flexibility.
And why is that specific partnership form so critical for venture capital?
Because VC needs custom economics. Managers have to define very specific profit splits, what we call carried interest waterfalls, and allow for side letters with big investors. A normal corporate structure is too rigid for that.
But the SCSp lets them tailor the rules contractually.
With incredible ease, that contractual freedom is what lets them build these huge, complex international funds.
And just to be clear, these are not for retail investors. This is for the pros.
Absolutely. High risk, high return. You have to be a professional investor or commit at least 125,000 euros and, sign a declaration saying you understand the risks. It's sophisticated capital only.
Okay, let's move from theory to practice. Walk us through the standard blueprint for a Medtech VC platform using this architecture.
The blueprint is really a stack of entities. At the top, you have the fund vehicle itself, the SCSP-RAIF, with different compartments for different strategies.
Okay.
Below that is the management layer. You'll have a general partner or GP, usually Luxembourg Sarl, that handles the business decisions.
And the regulatory anchor is the AIFM.
Yes. The AIFM is critical. It handles risk, valuation, and most importantly, it's what passports the fund across the EU. And then the investors, the LPs, subscribe into that SCSp.
So let's make this real. Give us an example of how this solves a real-world problem, a pan-European fund, maybe.
Perfect example. Imagine a manager raising, say, 250 million euros for seed and Series A deals, AI diagnostics, minimally invasive devices, in 5 different countries.
Okay.
Using this RAIF SCSP structure means they're LPs from all over the world. They only have to sign one subscription agreement that's fully EU compliant.
And this is where that look-through reporting you mentioned comes in, which is vital for LPs, isn't it?
It's essential. It means even though the investor is putting money into a Luxembourg fund, they can see all the underlying assets right down to the specific startup. They need that for their own tax obligations back home in the US or Japan.
It avoids a regulatory nightmare.
It does. It just smooths the whole process.
Okay, what about a US manager who wants to tap into European capital?
That's a classic case, the US Feeder Fund. A manager in Boston is raising, say, $600 million for growth stage surgical robotics. Their main fund is in Delaware.
Right.
But they need money from European pension funds, and those funds need AIFMD compliance. So they set up a Luxembourg RAIF SCSP as a feeder fund.
So this feeder just collects the European money.
It aggregates the European LPs, satisfies all their regulatory demands with the AIFMD passport, and then it funnels all that capital into the main Delaware master fund.
So it's using the Lux structure purely as an on-ramp for EU capital.
Brilliant. And the corporate venture arm.
Another great use case. A big listed German corporate wants a strategic venture arm of, say, 150 million euros. They can use a RAIF SCSp to house it.
And why would they do that?
Two main reasons. First, it professionalizes the whole operation. And second, it explicitly ring-fences the risk.
Meaning if one of their high-risk digital health investments blows up, the failure is legally separate from the corporation's core balance sheet. It protects the mother company while letting them play in the high-risk, high-reward venture space.
This is where it gets really interesting for me. Medtech has these unique risks, clinical trials, regulatory hurdles that normal tech VCs don't touch. How does the governance structure adapt to manage that?
The AIFM can't just look at spreadsheets. It has to integrate clinical due diligence. The risks are huge. Regulatory approvals from the FDA versus the EMA, clinical trial success rates, reimbursement pathways.
And massive data protection and compliance, I'm sure.
Huge. So the governance has to reflect that. For instance, the fund's investment committee must include both financial experts and senior clinical experts. And often, more critically, you'll see a dedicated scientific or clinical advisory board, the CAB.
And what is the CAB actually doing? Are they just rubber stamping ideas?
Not at all. Their role is technical validation. They review the trial design of a company the fund wants to back.
So they're asking questions like, are the endpoints statistically sound? Is the patient group right?
Exactly. Is the regulatory pathway realistic? The AIFM has to integrate that feedback into its risk model before any capital is committed. It's about embedding science into the financial process.
That's crucial oversight. Okay, finally, let's talk ESG, environmental, social, and governance. How do medtech funds fit into the SFDR rules?
Well, medtech funds are almost naturally aligned with the S for social. They almost always qualify under SFDR Article 8, sometimes even Article 9. They promote social benefit by default.
So what's the key? Just formalizing it?
The key is formalizing and measuring it.
Give us some concrete examples of what they might measure.
Okay, we look at real impact. Devices that demonstrably reduce hospital-acquired infections or patient readmissions. That's a massive social and financial win.
Sure.
Or digital tools that improve access to care in regions that lack specialists. That's a clear social characteristic. The fund structure forces the manager to turn these into real KPIs for their investors.
So the structure isn't just managing financial risk, it's formalizing the delivery of social good and aligning the investor's goals with patient outcomes.
It connects the dots, all the way from capital raising to clinical impact.
So to summarize for you, the listener, structuring Medtech VC in Luxembourg delivers EU-wide reach at the passport, tax neutrality at the fund level, really fast time to market with the RAF, and this scalable platform that can host multiple ring-fence strategies. It's just an engine of efficiency.
It is. And if you connect this to the bigger picture, all this complexity, the SCSp-RAIF, the AIFMD passport, the clinical advisory boards, it's all designed to do one thing.
Which is?
Deploy capital quickly across borders while expertly managing these deep, unique risks. It's all about preserving returns for the investors, the LPs.
So what does that efficiency really mean for the industry?
Well, that raises an important question, something for you to mull over as you watch this space grow.
Yeah.
How much faster does this streamlined cross-border funding model move critical, life-saving devices and digital therapeutics from the lab bench into the hands of patients globally, especially compared to the old, fragmented, country-by-country model? That's structural efficiency. It isn't just about money. In life sciences, it's about time.